Earlier this week, I had the pleasure of sitting down with Ed Fischwick. He's co-head of BlackRock's Risk and Quantitative Analysis Group. He's on the main board of BlackRock internationally. It's a massive organization. $3 trillion is the assets they have under management. We chatted why this company is investing into Africa.
You know, when you look at the distribution of what we do around the world, we do a great deal in the States, we do a great deal in Europe and Asia, but over the recent past, absolutely, we see an increasing number of clients looking to invest globally with us.
Your focus is obviously on risk. If one talks risk, you think 2007, 2008, the whole financial meltdown. Have things changed?
Well, 2007, 2008 changed lots of things, and it either taught us lessons or reminded us of lessons that we knew all along but had forgotten. So the global financial crisis transformed the way in which you think about risk, particularly in the developed world. So when I think about risk management pre the crisis, I would say that risks in developed markets are about economies and markets, and all the risks in emerging markets, developing markets, were political. So you invested in emerging markets and you worried about political risk. You invested in the US or in Europe and you worried about the economy. And the global credit crisis changed all that. And it changed it in such a way that now policy risk and political risk is everywhere. And so when you think about investing in South Africa or the USA or the UK, you're always very focused on government policy, monetary policy, and so on and so forth. And if you think about the current debate globally around QE and tapering, the changing of monetary policy, and the way that's impacting asset prices in the US, in the UK, and here, you see this pervasive influence of policy, all of which stems from the credit crisis.
The whole quantitative easing story must make risk management pretty tricky, because it introduces new risks which we possibly don't understand yet.
That's right. It might even be better to describe them as uncertainty. There are just things we don't know about. So sometimes I think of risk management as managing the things you understand and can quantify. And then uncertainty is the stuff you just don't know. And so QE is uncertain in many dimensions. So firstly, all the obvious things like the timing, we don't know when it's going to happen, the scale, we don't know how big that reduction in asset buybacks will be. But then we don't really understand the mechanisms by which QE affects the outcome. So after the announcements May 22nd, when the Fed said we're going to begin tapering, you saw that huge reaction of asset prices everywhere, including in South Africa, where the price of high-yielding assets fell and the behavior of currencies was very dramatic, all of a sudden very highly correlated. But beyond that, it's very hard to gauge how long-lived these effects are, and so on and so forth. So from a risk management perspective, it makes it harder, it increases event risk, it increases the potential for upset suddenly in markets. So it makes life pretty interesting, but it makes it harder.
And as a private investor, what should one be watching for on QE?
So private investors, to the extent they hold high-yielding assets, to the extent that they look for income through that route, I think the elimination of support for assets probably reduces asset prices in some of those higher yielding areas. And they should just look for short-term volatility. So you can see that every time there's a new piece of news around tapering, it introduces big asset price volatility. My own view would be it's probably a mistake to respond to that, because a lot of this stuff dissipates through time. They should also worry about the fact that it makes things more correlated, but again in the short term. And so, you know, my instinct is that for a long horizon investor, QE probably doesn't change very much. Might throw up a few opportunities, but it probably doesn't change very much. For anybody with short-term objectives, then it's a big deal because it has the potential to disrupt asset pricing a great deal in the short term.